Hello, all. Very good evening to all the attendees who have joined us today for the webinar. Welcome to the webinar series of Advait. I'm Shrilata, a chartered accountant and working with Advait in the team of knowledge and solutions. And I have with me CA Krishna Upadhyay sir, co-founder of Advait iTech Private Limited. Welcome, sir, for today's session.
Good evening, Shrilata. Thank you so much, and good evening to everybody.
Well, as you know, we are currently in the webinar series on ESOPs, employee stock option plans, with an objective to understand ESOPs from more of a value perspective and not just as a compensation tool. To understand how ESOPs treat or recognize employees as economic participants in the value that the organization creates. In our previous session, we had covered the foundational aspects like what an ESOP is, how this mechanism is structured, what kind of problems it resolves, its life cycle, stages, its connection with the market system, etc. The whole idea was to give you a conceptual framework as to what this mechanism means and how this functions. If you had missed attending it live, you can watch the recorded one on our YouTube channel. We have streamed it. In today's session, we'll continue our discussion on ESOPs, but we will be looking at them exclusively from employees' lens, from employees' perspective. So this session aims to build certain level of awareness around how ESOPs work in practice and what they mean for you as an employee at different stages. Uh, Most often what happens is employees tend to feel that ESOPs are something they don't really need to understand and everything will be taken care by the company. While most of the formalities are, of course, taken care and handled by the company, it's equally important for you to have a certain level of understanding, awareness, and the need to know key triggering points so that you're able to plan things better, avoid unexpected surprises, and ensure that the outcomes from your ESOPs align with your own expectations and financial approach. To start with, let's do a quick recap of what we had discussed in our initial session, which is the life cycle of ESOPs. As an employee, the first stage is where ESOPs are granted to you. This essentially means that you receive a potential right to acquire shares of the company at a predetermined price. However, this right does not become immediately exercisable. You are required to complete the vesting period, which typically comes up with conditions such as continued employment conditions, performance requirements, etc. Once these vesting conditions are satisfied, you enter the exercise phase where you can actually exercise the options that have been granted to you, and you can acquire the shares of the company. After exercising, you may continue to hold it like an investor and eventually sell them at an appropriate time as you determine and realize value in cash. This is how the life cycle works, and this is what we had covered in our initial session as well. Now, these ESOPs are typically allocated either directly to employees, where shares are issued by the company at the time of exercise, or this entire ESOP administration activities handled through an ESOP trust mechanism. Under this, what happens is the company sets up a trust which holds the shares on behalf of employees, and when employees exercise their vested options, the shares are transferred from trust to those specific employees who exercise them. Now, why the trust route? It provides greater administrative flexibility for the company. It allows companies to manage employee entry and exit more smoothly, efficiently. They can plan dilution in a structured manner and efficiently handle situations such as buyback or liquidity events. It also avoids the need to frequently issuance of fresh shares every time employees exercise options. And from employee perspective, if you see, though the route is different, the underlying economic benefit and ownership largely remain the same. Uh, if you see ESOP framework, ESOP mechanism at a overall basis, it largely dependent on how the scheme is structured. So the ESOP scheme plays vital role here. Because in certain scheme, what happens is exercise will be linked to liquidity. Means you can exercise your options only when liquidity events happen, like buyback, secondary sale, or listing, and so on and so forth. From a practical standpoint, this helps to avoid cash flow burden since employees are effectively buying and selling at the same point in time and are able to realize value immediately without the need to arrange separate funds for exercise. But from a tax standpoint, there is a flip side as well, which we will cover when we discuss the tax trigger in subsequent section. Now, with this brief context, sir, can you take us through this phase of an employee becoming a shareholder and related aspects and insights around how voting rights, dilution, and dividends have an impact?
Yeah. So, like Srilata was mentioning, there are different methods and ways in which employee stock options can be granted. So, by and large, there are probably three kinds in which it is granted to you as an employee. One is a employee stock option plan, we popularly known as ESOP, employee stock purchase plan (ESPP), and restricted stock units (RSUs). Each of them have different underlying regulatory aspects to it, and also methods in which it works. There's another one which are called also stock appreciation rights, also called as SARs. Now, what happens in each of them is that in a employee stock purchase plan, so the employer allows you to buy shares of the company at a heavily discounted price. Let's assume the price per share on the day you have the power to exercise, that is, your vesting period is over and your exercise date has come in. Let's assume the market value of the share as on that day is 100 rupee. Employer allows you to buy it at a 80% discount, 85% discount, 90% discount. So what essentially happens is you're getting an asset worth 100. It may be a 10 rupee or a 15 rupee or a 20 rupee. So this is an employee stock purchase plan. In this, what happens? There is a cash outflow to you in the form of the money that you have to pay to subscribe to those shares. Typically, this is a plan that is used by listed entities which are giving out stock options to employees. In more popular startup kind of an ecosystem where stock options are given, they're typically given as ESOPs, that is employee stock option plan, and that could be in the form of a option, in the form of a restricted stock units or a SAR. What are these and what does it impact to all of you as employees who get this? Now, firstly, what it does is that in none of these you have a cash outflow. You don't have to pay for it. You will have to meet the underlying conditions of your employment or whatever, which are dependent on the stock option plan or scheme that your company has actually floated. In, let's assume, an employee stock purchase plan or a plan where an option is converted into shares of the company, restricted stock units of the company immediately. Again, depending on the kind of share that is issued to you, which is also dependent on the regulatory conditions and the scheme that is drafted by your company, you could become on par with any other shareholder holding complete right of voting. You will also have the right to get dividends if at all dividends are declared by your company. You will be on par with the other shareholders who have invested money or purchased shares from open market or in any other form. Now, what happens is that in a stock appreciation right kind of a scenario, you will not become a shareholder per se. That is, you don't enter into the share capital table or members register, to be very technical in these kind of situation. However, you get all the rights of getting monetary benefit on par with the shareholder. Let's assume the company declares dividend. Even as a holder of a SAR, stock appreciation right, based on, of course, dependent on the scheme, dividends can be declared to you and issued to you. Let's assume there is a buyback that is happening. SARs are also part of the buyback. It monetizes for you. So all the upsides or the benefits of a share is still continuing. However, you may not be a shareholder having a right to vote in general meetings. As a shareholder, you have right of certain information. Let's say you can apply to the company and get its financial statements by paying a fee. These kind of rights will not be there, because essentially the whole point here is that why are stock options granted to employee? They are not granted to employee to become like any other shareholder, not to exercise your right as a shareholder, but to give you a monetary upside. Let's assume there is a startup founder who thinks that there's a fantastic company and a fantastic idea that they're working on, and they need great people to join them at the beginning of times. So, and the company is not financially capable to pay the kind of salaries that the market would pay for a similar skill set. Instead, what the founders or the founding team convinces the employees to say that, look, I will make sure that you participate in the monetary upside that is going to come once the company becomes bigger, once there is a larger traction that comes into the company. Therefore, I will give you something in the form of stock options. You hold that. I will make sure that there is a liquidity that you get, and that liquidity will make sure that your monetary benefit is taken care of, and a wealth creation also happens for you. So the objective here is actually giving that monetary benefit, and therefore some of the rights may be restricted, and it also makes it easier because such startups will be in the continuous spree of raising funds. There are multiple rounds of investments that are happening. At each stage of investment that is happening, there are a lot of documentation that a shareholder has to sign off. So in these conditions, it becomes extremely difficult for the board or the founders to have those many number of shareholders sign all those documentation and give all those approvals. Therefore, such restricted stock options will be given out. Now, what becomes important from your perspective is not to know the detail of all of this, not to know the technicalities of all of this, but to know your rights, to know your obligations as a part of holding those. If these are stock options and you don't have to pay for it, there is no cash outflow. So that is something that you need to know. However, if those are stock purchase plan, there is a cash outflow. You might have to pay some money to get those stock options. So to that extent, you need to understand whether there is a monetary outflow or no monetary outflow. Second, companies can structure these as proper shares that come to you either individually or through a trust. If it is individually, you will become like any other shareholder. There may be a lot of obligation and right for you. But if it is through a trust, most of these rights will be with the trust which is created particularly for administering these stock options. Therefore, the trustees who are appointed in the trust, who will be typically people of public interest, who will be well known in the industry, etc. They will be, and people with good credence will be appointed as trustees in this, so that they administer that in favor of the employees, and they will be exercising these rights on your behalf. However, if these are structured as restricted stock units or stock appreciation rights, whereby you don't necessarily get shares, what you get is a right to get appreciation and value of the shares at a certain point of time, or an option to exercise these stock options that are in your hands at a later point of time, which will convert into share. I will give you an example. Let's say you are ESOP holder of a company which just went into into IPO. Let's say there is a large company which went into IPO recently. Let's assume you are the option holder of that company. Now, what you might have accumulated these options over the last 3, 4, 5 years time, but you wouldn't have become a shareholder. But just before you're going for IPO, your company's stock option scheme would have made sure that you can exercise those options and get the shares just before IPO, so that when the IPO happens and when the shares are listed in stock exchange, and after the mandatory cooling off period where you're not allowed to transfer, immediately after that, you have the flexibility to sell your shares in open market as and when you want. So these kind of events will be tagged along with the time period for exercising your options, typically called as liquidity periods, and it will ensure that you are protected, you get your liquidity, but there are certain benefits of doing it. Those benefits you'll understand when we talk about the taxation aspects. When Shilata, eventually will talk to you about the tax, that time you will understand what is the benefit. So from an employee standpoint, all of you have to understand that there can be different forms of giving these stock options. Each of them might have different methods in which you get your rights, time period in which you get your shares, and time period in which you get the upside in the value. Bottom line, these are designed to give you monetary benefit and to give you a wealth creation opportunity.
Yes. Thank you, sir. So now that we have broken down those initial phase where the life cycle, how it actually impacts from an employee standpoint, let's move directly to the taxation points. So coming to the tax triggers, this is one area where employees should clearly understand when tax actually gets triggered in this entire life cycle. In the case of ESOPs, tax typically arises at two different stages. The first trigger happens at the time of exercise. For example, when you exercise your options, the difference between the fair market value of the shares on that date and the exercise price that you are paying would be treated, the difference would be treated as perquisite. And this amount is taxed under the head salary. Now, in the same case, in case of ESOPs, the second tax trigger arises when you eventually sell the shares. At this stage, the difference between the selling price and the value at the time of exercise becomes it is taxable as capital gains. Now, whether this is to be treated as short term or long term depends upon the holding period of the shares, which is calculated from the date of exercise until the date of sale. Like I had mentioned in the previous section, when exercise is linked to liquidity, since exercise and sale happen together, a significant portion of the gains may get taxed as salary income as perquisite, leaving lesser scope for capital gain taxation. As a result, the overall effective tax rate may be higher when compared to situations where exercise is not linked to liquidity. Now, moving further in this whole discussion of taxation, let's understand what your employer will do. At the first tax triggering point, which is at the time of exercise, since the perquisite is taxed as salary income, the employer is required to deduct TDS at the time of exercise along with regular salary taxation, and the same would get reflected in Form 16. From an employee perspective, though most of these complaints formalities are taken care and handled by employer, it becomes important that you should be aware of these trigger points and maintain relevant documentation so that you clearly understand when taxation arises, when you need to be ready with fund arrangements, and how should it reflect in your overall tax returns. With this basic tax trigger awareness, now I would like Krishna sir to provide insights around this, including cases where foreign shares are being received by an employee in India. For this, over to you, sir.
Yeah. So, like Srilata rightly pointed out, what happens is because these stock options are granted to employee for rendering your employment services to the company, the value of benefit that you got in the form of these stock options is treated as salary, and your employer is required to withhold taxes when these stock options are exercised by you. So if you have heard our previous webinar, you'll understand that there are multiple stages. The first stage is called as the vesting period. Vesting period is a period where your accrual of stock options commence. It's a period where you have to continue rendering your employment services. At that time, when it commenced and that vesting period is ongoing, you have no tax to pay. There is zero taxation. When that exercise takes place, whereby you say, yes, now I have completed all the condition, I want the stock options to be converted into shares. At that period is when the taxation trigger happens for the first time. Now you have to understand that at that time what you are getting is a non-monetary benefit. You are getting a share, but you will have to pay tax on that. So therefore, what essentially happens is that there will be a cash outflow from your hand. And how is this value computed? Like Srilata mentioned, the fair market value of these shares will be considered as the value of perquisite and included. Now let's take a couple of scenario. Scenario number one, let's say there is an Indian entity which is you are an employee of, and that entity is giving its own stock options to you, and it is a plain vanilla stock option plan. When you exercise that, shares are credited in your favor. In such situation, every time there is an exercise that happens, the Indian entity will get a fair market value determined, and then tax is computed on that. And whatever money comes in will be typically recovered from your monetary salary that is being paid out for you every month. Let's say in money, there is certain salary that is being given out to you. Let's say 2 lakh rupee a month. By exercising these stock options, on these stock options, there is a taxation of 50,000 rupee that is getting determined. Out of the 2 lakh rupee that is paid to you, the 50,000 is withheld, and 1 lakh 50,000 is paid, and shares are given in your favor. What did this do? Though you got a non-monetary benefit in the form of shares, you had to end up shelling some money out as tax. Now, this is slightly inefficient if these are for unlisted company, because you don't have an immediate monetization of these shares. Like I mentioned in my previous section when I was talking, that these could be startups where continuous rounds of funding is happening, and then eventually it may go for an IPO. Or in one of the rounds of funding, investors, the founder may negotiate with the investors to state that buy out all the ESOP holders and give them liquidity, or the company accumulates enough money to buy back shares and give money to the employees. Till such time it has not happened, what will happen is that you will end up paying tax on these, but you would have only got shares, liquidity wouldn't have happened. That is why there are stock appreciation rights and options which are only converted at the time of liquidity event, are some of the popular methods in which current startups are structuring their ESOPs. Now let's take a second example. Let's take for scenario whereby you work for an Indian company which has a foreign holding company, and that, let's say that foreign holding company is listed outside India in a stock exchange. Let's take that some company is listed in London Stock Exchange, and you work as an employee in the subsidiary of that company. As a part of your compensation package, you also get those foreign listed shares as a part of your perquisite. Then typically what happens, India taxes whatever has to be paid out. The moment this vesting period is over and the exercise happens, the foreign holding company, through its agents or through its people who are administering this entire ESOP scheme, they themselves will automatically sell some of the shares in the open market, recover the taxes, and give you net of that. Let's imagine you were to get 100 shares, and the tax comes to a certain amount, and that day's market price makes that if they sell 10 shares of yours, the tax can be recovered. What they will do, immediately they will sell those 10 shares, 90 shares will be credited to you. What will this ensure? This will ensure that there is no separate cash outflow from your hand from the monetary salary that you're getting, but the shares are sold immediately. This way, the entire scheme of things work out. And while doing this, they would ensure that they treat all of this in your Form 16. All of this will be declared. And if there are these foreign shares, typically in our practical experience, we have also seen that these agents, these stockbrokers or whoever they are, administrators, as we may call it technically, will give you a platform where you can observe all of these. How much did it get credited? At what value was it sold? How many shares were sold? All this will be displayed to you correctly. One word of caution. Whenever there are these kind of shares allotted, whether Indian shares or foreign shares are allotted to you as stock options, and taxes have already been deducted by your employer, don't think that your obligation is over. There are disclosure requirements in both of these scenarios in your income tax return, and particularly when you hold foreign shares. These shares have to be declared in your ITRs that you file as foreign assets. Not declaring them have huge penalties under the Black Money Act. You may say that what black money, I've already paid taxes on it. It's not enough. The tax return makes it mandatory for you to disclose those foreign shares in your tax return, and failing which you could be exposed to penalty. Therefore, in such situations, take the help of your tax consultant, file your tax returns correctly so that you are not violating any law. The last bit on taxation is about capital gains, like Srilata touched upon. Whenever you sell these shares, whether in case where the option is exercisable at liquidity event, or the options were exercisable earlier and you held on to those shares for a time period, there will be a second tax trigger, which is a capital gain trigger. Depending on the period of holding of your shares, it could be a short term or a long term capital gain. We have seen in our practical experience a lot of people missing out declaring these capital gains, thinking that, hey, my employer had already deducted TDS on this and my tax obligation is over. That is a misconception, because eventually, when you sell these shares, the value that you may realize is much higher. That means the value at which you paid a salary tax as a perquisite tax earlier versus the value at which you sold eventually was higher. Therefore, there will be capital gains and you will be liable to pay capital gains tax.
Thank you, sir. So, in continuation with this taxation point, let's briefly talk about the valuation aspects. See, from an employee perspective, it's important to understand that valuation directly impacts your taxation. As we discussed earlier, at the time of exercise, the difference between the fair market value of the share and the predetermined exercise price is treated as a perquisite and taxed in the head of salary income. So naturally, a higher fair market value would result into a higher taxable perquisite. Valuation also becomes relevant at the time of sale, not just at the time of exercise where perquisite taxation gets triggered. If shares are sold at a price lower than the applicable fair market value on that date, the income tax law requires that for computing capital gains, the fair market value to be considered as the selling price rather than the actual lower price at which the shares are being sold. So even though employees may not have direct control over company's valuation, understanding its impact helps in anticipating tax outcomes at different stages. Now, in case of listed companies, valuation is largely determined based on prevailing market prices of the shares as they are available at any point in time. For unlisted companies, fair market value is determined through an independent valuation carried out by a registered merchant banker. This valuation reflects the company's financial position, growth potential, and market outlook at the given point in time. It's also important to note that funding rounds can significantly influence fair market value. Let's take a simple example. Let's say if shares are valued at rupees 100 today as per registered valuer or the merchant banker, but a new investor subsequently, let's say after 2 3 months, a new investor subsequently agrees to invest at a price which is bit more higher, let's say around 200 or 250 per share, based on future potential. Then at that point in time, a revised valuation may be undertaken to reflect the updated market confidence. So potentially, if you see, if you exercise very much before the funding round, you tend to get the shares at a lower value. Sir, would you like to add any key notes here, especially to employees from valuation perspective?
Yeah. So, like you rightly mentioned, Shilata, so there is no control for the employees on the valuation or how it is determined,
Yes.
etc., because this is very technical. There are rules and regulations on this, market forces that are working. But what a good and a well drafted stock option scheme does is it allows the employees a certain time period, a band by when they can exercise these options and convert them into shares. Now, you'll all have to understand as employees that if you are getting paid by way of shares and you have agreed to that with your employer, you need to be aware about these kind of rights that you have. You'll have to make a fair assessment about when the value could be what, and when if I exercise these options, what will be the taxation that I will have, and all of these. And typically, most of the companies would have created a window or an option where these questions will be answered by the finance team and tax teams of the respective companies. So it's your duty to understand that. If you don't understand that, seek that guidance from the company who's giving you those stock options. And more importantly, you'll also have to consult your tax advisors to make sure that these are correctly told to you. You are an aware taxpayer and do your obligations correctly. So, thereby, this will make sure that one, you don't end up paying too many taxes at an unwanted period of time. Two, let's say there is a window and you did not exercise your options by that time, it can so happen that the options may extinguish because that is how the scheme is drafted. Three, let's assume you held on to some options for way too long and now you are quitting the company. And the scheme is such that if only options are there and when you quit the company, those options expire. You don't have an right to exercise them. But if you were to have exercised and got those shares, there was a mechanism that the company has already done where it will either buy back at a certain price or allow you to hold it till the next round of funding by when exit is given. All these are detailed out in employee stock option schemes, and it is mandatory under the law for the company to distribute these schemes to all the people to whom these stock options are given. Read them carefully, understand your right. If you don't understand, consult your tax advisor so that you know what you are getting into.
Yes. Uh, sure. Thanks a lot. So I was about to come to the summarizing point. I think few of the points have already been covered, but still, as a note of completion, to summarize from a practical awareness perspective, whatever we had discussed in previous three sections, as an employee, you should have a clear understanding of how your ESOP scheme is designed, like Sir just pointed out, and be aware of the different phases of the ESOP's life cycle and know the key tax triggering points so that you can assess if you have any liquidity risk or if you have to arrange some funds, and you can plan accordingly. And it's also important to maintain relevant documentation, and you need to be aware of disclosure requirements in your income tax returns, and you need to comply accordingly. While these checklists or keynotes or pointers may appear straightforward, in practice we have seen several situations where misunderstandings or lack of awareness or misconceptions that lead to unintended outcomes. So, with that context and in the interest of time, sir, can you share some top one or two practical experiences around these areas and guide the audience in overcoming these problems?
Yeah. So, one of the biggest misconception or a problem that we have noticed over the last 2, 3 years is, like I was mentioning in one of the examples, a foreign holding company grants its options to employee of its subsidiary. Let's assume that subsidiary is in India and you're an employee of that company. More often than not, almost all of these employees who got the stock options in India and thought that taxes has already been deducted on it forgot to disclose two things. One, the share that they got, which is a foreign asset because it's a share of a foreign company. Two, to administer this entire money movement, that is when you sell the shares in a foreign stock exchange, the broker will collect that money and has to give it to you. To do that, they would have opened a bank account over there, very similar to a savings bank account in India. Now, these both are foreign assets, and it is mandatory under the income tax rules in India to declare any foreign asset by a Indian taxpayer, a resident taxpayer in India. more often than not, we have seen that all of them have missed declaring the shareholding as well as these bank accounts in their tax returns. And the Black Money Act treats these as undisclosed black money asset. And India has a very strong network of data exchange with almost all the countries in the world. And income tax department has been getting the data of all these people from around the world. There were notices issued levying massive penalties for not disclosing these in the ITR. One good thing that has happened in the budget that got presented on February 1st, 2026, whereby a new amnesty scheme has been brought out by the finance minister. It is under a proposal stage, under discussion by the Houses of Parliament. Under this scheme, what has been done now is that one time amnesty has been granted, whereby if you have missed declaring these assets after the perquisite taxation has already been paid, you need to pay a certain fee one time, and then any past errors are forgiven. Second, let's assume you sold some of these shares. You forgot to declare the capital gain that arose. Those will be again counted as black money. And even in such situation, there are some taxes that you have to pay and some additional taxes which may go up all the way up to 70%. You'll have to pay that out, and then all your past mistakes will be forgiven. Make sure that you use this scheme. Otherwise, Black Money Act not just levies penalty, there are prosecution provisions as well. I'm sure the intention of most of the employees who have not declared that in their ITR was not to hide this, but it was ignorance. But one needs to understand that ignorance is not a bliss, and that is not allowed under the law. As it is your obligation to declare. Now, with this amnesty scheme that has been brought in, please come clean with all your records. Consult your tax advisors, they'll help you out with how this has to be done, etc. once the scheme is notified. Currently, like I said, it is before the parliament to make it into a law. Once it is made and notified, tax department will come out with the specifics. Keep waiting for that to come out, or consult your tax advisor to make sure that you are compliant.
Yeah. Thank you, sir, for these practical experiences and insights towards these aspects. And with this, we have come to the end of this session, and we believe that today's discussion really helped employees in having the required awareness and taking decisions with clarity. And employees shouldn't be having any surprises, is what the objective was. So with this, we have come to the end of this webinar. And I would like to thank Krishna sir once again for the insights, and all the attendees who have joined today's session and who have spent time for this learning. Stay tuned for our upcoming session on this series, where we are going to cover things from employer lens as well, with advanced strategy considerations and cross-border arrangements. Meanwhile, if you want to know more, you can visit our website, read our blogs, and subscribe to our newsletters, and stay updated with key finance insights. Thank you, one and all.
Thank you so much.